This is week 2, problem 1, and it says it's in regards to creating T accounts. And if you look down here, you see a T account, and on the left hand side, it is the debit side, on the right hand side is the credit side. If you're under assets, anytime you add money to a specific account, it would go under debit. Anytime you take money away, it would go under credit. If you go under liability and owner's equity, the other would work. So anytime you add money to a specific account, it would go under credit. Anytime you take money away, it would be under debit. So let's start with the very first example. It says invested cash in the business for $5,000. So let's write on columns F and G. Let's write down the accounts that will be affected. Cash we know will be affected, and we also know capital will be affected. So if you look under cash, the amount that will get affected by $5,000, we would debit $5,000, and then we go under capital and we would credit $5,000. That means that our debits are equal to our credits on in this transaction. Transaction B says purchase supplies for cash for $1,000. So the two accounts that get affected are supplies and cash. So we'll go down here. So we have purchased supplies for $1,000. So they're both under assets. So we have purchased supplies for $1,000. So we credit $1,000 and then we debit supplies for $1,000, and we are done with that transaction. The next transaction is pay telephone bill for $600. So we know cash is getting affected and phone expense is getting affected. So cash would be affected, or we would credit for $600, and then we go over on the owner's equity where the phone expense is, telephone expense is, it is for $600. And unfortunately, and on this side we actually debit $600. So that way our credits are equal to our debits on this side. The next transaction is earn delivery fees for $1,500. We know that delivery fees are revenue, or just say delivery fees. We have received $1,000 in cash, and we've received the rest on account. So the rest on account receivables. So let's go over to cash and let's see how much we've received in cash. We've received $1,000 in cash, so we're adding money to cash. So that would be $1,000. Let me just put it underneath here. That'd be $1,000 in cash here, and then an extra $500 on account receivables, and our revenue would be $1,500. And if you look over here, this $1,500, which is on the credit side, is equal to our debits over here, 1,000 plus the 500, which equals out to be $1,500. The next transaction is transaction E. It says paid rent on company building for $650. So we know we pay rent with cash, and it affects the rent expense, and it is $650. So we're taking money away from cash, so $650 under the credit side for cash, and then rent expense would be debiting it $650. The next transaction is owner withdrew $350 for personal use. So we have cash that's getting affected and drawing that's getting affected. Cash is getting affected, or we're crediting it by $350. And drawing, we're debiting it by $350. And then we have part G, which is earned delivery fees of $5,000. So we know that that would be revenue fees for $5,000. Some of them $4,500 in cash, and the rest on account receivables. So $4,500 in cash. So we debit $4,500 here, and then account receivables would be 500, and then our delivery fees would be 5,000. All right, so we are done with that as well. And the next one is pay telephone bill of $75. So the telephone bill of $75, we obviously know we will be paying with cash, and it is phone expense. Phone expense. So we credit cash for $75, and then we debit telephone expense for $75. We are done with that transaction. The next one is purchased computer equipment on account for $3,000. So that is computer equipment on account and accounts payable. So computer equipment was, we debit computer equipment by $3,000. And then obviously we take out a loan for that. So we credit accounts payable for $3,000. The next transaction is paid part-time employees for $1,000, so we pay them with cash, and that would be wages expense that is getting affected. So we are paying $1,000 worth of it. And then wages expense, we debit $1,000. And then the last transaction, it says paid $1,000 on computer equipment purchase. I'm going to cut this so that way I can just decrease it, cut it a little bit, put it a little bit lower so that way we will have room. Oops, hold on just 1 second. So that way we'll have room to actually input our answers and insert. I just cutted it and I'm going to paste it here. Okay, so now we have a little bit of room to insert a few rows here. All right, so then in the last transaction says paid $1,000 on computer equipment purchase in transaction I. So that would be cash, we paid it, and accounts payable. And then we've paid $1,000 worth of it, so we credit $1,000 here, and then we debit $1,000 on accounts payable since we're paying out. Now I'm going to balance each account, so I have the sum of your cash right here. And then I would have to do minus the sum of your credits. And then it would be equal to your debits minus your credits. That equals 5,825 would be the balance for cash. And obviously if it is under cash, because anytime we add money it's under the debit side, your positive amount would have to be on the debit side. Here the supplies, obviously if we had depreciation we would have to for the balance, so we would have to do, the sum of your supplies and the sum of your depreciation on this side. We haven't covered depreciation yet, so I'm just going to do 0. So your balance over here, it would just be 1,000 as of right now. Never mind. Let's just do 1,000 here. If I could, oh. All right, let's just do 1,000 over here, and then account receivables obviously is 1,000 on this side. Your account receivables, you haven't received any money back, so your balance is $1,000 on account receivable. That is with yellow as well. I'm just doing it with yellow. The balance is. Your computer equipment is $3,000. It has not depreciated yet, so your balance is $3,000. So, and I do that with yellow. Your accounts payable, you have gotten a $3,000 loan. You paid $1,000 worth of it. Basically, you have left is the 3,000 you received minus the 1,000, so you have left 2,000 to still pay. I'm going to do that with yellow. The same thing goes with capital. I mean, nothing has been depreciated, so you still have 5,000 on this side, 0 on this side, so your balance for capital is $5,000. I'm going to highlight that with yellow. And then you have drawing, which is 350 on this side. Oh, I'm having a hard time because I have not included the number. I've always click on the numbers lock. All right, and then your balance is 350 still. And then we have 650 for the rent expense. So your balance for the rent expense is 650. And then we have delivery fees 5,000 plus 1,500, 6,500. Nothing has been returned, so our balance is 6,500. And then we have the telephone expense, which is the sum of 6,000 plus 75. You could either do this, it'd be 675, and then your balance would just be 675. And then we have wages expense of 1,000, so 1,000 over here. There were no mistakes, so your balance is 1,000, and we have that. All right, and then we know assets are equal to liabilities. Here, let's write assets is equal to liabilities plus plus uh, plus owner's equity. Our assets is basically the sum of all these yellow lines, so it's this line right here. Basically the balances of each account under assets, this one right here, and then we have this one right here, and then we have this one right here. So our balance is 8,825. Our balance for liabilities is $2,000. What do we choose? Where is the $2,000? There we go. $2,000. And for owner's equity, it is basically the sum of your capital and revenue, your capital and revenue balance, minus the sum of your drawing, of your rent expense, of your telephone expense, and of your wages expense. And I would enter it. So 8,825. So this 10,825, which is under assets, have to be equal to your liabilities plus owner's equity, which is the sum of these two, and it's the 8,825.